Hello, everybody. It's John Edwards, your retirement safety coach here. And today, in this video, we're going to talk about a new strategy that can help to control the risk in your retirement a little bit. So, this is a new strategy. They're called trend following ETF. It's an approach that aims to keep you aligned with the market and positive trends, but it shields you from the worst of the downturns, basically. So, what is trend following? At its core, trend following it's an investment strategy that uses market data to determine whether to stay in or exit a particular asset. Instead of predicting market movements, it follows existing price trends, allowing investors to capture upward momentum and avoid prolonged downturns. Part one, many of these ETFs use the 200-day moving average. It's an average that a lot of technical analysts, they look at charts for stocks rather than looking at the fundamentals like earnings or something. They're just looking at charts and deciding when it's a good time to get in and get out of the market. So the 200-day moving average has been used for a long time in this way, and a lot of the ETFs do use it. It's a common indicator used for trend following. It's a simple moving average. This average shows the mean closing price of the market index over the last 200 trading sessions, and this gives us a smoother line of where the long-term trend is headed. When the stock market or particular index is above its 200-day moving average, that would indicate that it's a positive trend, suggesting it's a good time to invest and be in that market. Conversely, when it falls below the 200-day moving average, it signals there could be a potential downturn, which may be a good time to step aside or switch to a safer asset. Part two, why trend following works. All of us are human beings. We have emotions, and we're not always able to use logic because we get so caught up in our emotions. It's just a feature of being a human being. But if we can use a rule based strategy for part of our portfolio and remove some of that emotional decision making, we can have a much smoother ride. It's very common for investors to make reactive decisions. I've seen it a million times where people will buy the market when it's high out of excitement, and then they sell at the bottom out of fear. But trends following strategies, however, rely on rules rather than emotions, and that helps investors to avoid these common pitfalls. By following a rules based approach, trend following helps investors to participate in positive market phases and reduce exposure in negative ones. This can potentially provide steadier returns over the long term. Part three, managing downside risk with trend following. One of the biggest advantages of trend following is its potential to reduce losses during bear markets. Historically, the biggest losses tend to come once the index moves below its 200-day moving average. For example, during bear markets like the tech bubble, the 2008 financial crisis, and even the 2020 pandemic, substantial market losses did occur after the index had crossed below this key threshold. Trend following helps investors avoid these prolonged downturns by signaling an exit before things get too severe. Part 4, how trend following adjusts its exposure. A typical trend following ETF might operate with different levels of exposure based on market conditions. Here's how it usually works. Number one, we would have a full equity position. So when the market's in a positive trend and is trading above the 200-day moving average, the strategy might fully invest in equities, aiming to capture that growth. Number two, partial position or mixed exposure. If the market starts showing signs of uncertainty, such as fluctuating around that 200-day moving average, the strategy may shift to a 50-50 allocation between equities and 50% in safer assets like treasury bills. Number three, full safe haven position. If the market clearly downtrends below that 200-day moving average, the strategy will typically shift entirely into a safe haven asset like treasury bills, aiming to protect your capital. And this systemic approach helps investors stay invested during growth periods while offering some buffer against some of the worst downturns. And unlike buffered options, when this goes to cash, you're completely in cash, so you don't even have to participate. Part 5, custom transitioning back to full market exposure. Once the ETF is transitioned to cash, there may be instances where after we feel the market has had a bottom, we might choose to transition back into full market exposure on our own. rather than waiting for the ETF to reinvest based on the usual indicators. This is situational, but in some markets, we take this approach to minimize performance lag and to capture the market growth a little bit earlier than the ETF would be getting back in the market. Part six, liquidity benefits of trend following ETF. One notable advantage of these trend following ETFs is they're 100% liquid. So, unlike many other strategies with downside protection where you're required to lock up your money for a period of time, you have much more flexibility here because with these kind of ETFs, you're 100% liquid, which means you can buy and sell shares whenever you need to without worrying about waiting periods or surrender fees. Diversified portfolio, this liquidity can be quite valuable. It allows us to hedge part of your portfolio that you want to keep readily accessible, balancing that protection with the need for flexibility. Part 7, the limitations of trend following. So it's important to note that trend following, it's not perfect. It can sometimes lag behind market changes, especially during quick reversals known as whipsaw periods. This means that the strategy may not capture the very start of an uptrend or avoid the very beginning of a downtrend, but that's part of dealing with a rules based approach. However, for many investors, the goal is not to capture every single gain, but to avoid the large, prolonged losses that could take years to recover from. This can be especially valuable in uncertain markets, and it's also important as we get older and we're in retirement. We don't have as much time to make up and go through a whole nother market cycle again. Part 8, the bigger picture. Trend following is part of a diversified portfolio. Trend following strategies can serve as a valuable tool for risk management. While they may not suit every investor's portfolio, they do offer a great rules based approach to navigating market volatility. And by incorporating trend following, investors can potentially smooth out their returns over time and achieve a more consistent growth pattern. Remember, a trend following strategy should be just one part of a broader portfolio strategy. Ideally, you combine this with other investments to balance out growth and stability. To sum it all up, I'd say trend following ETFs, they aim to help investors participate in positive market trends while stepping back from those during downturns. For those looking to manage risk without constantly monitoring the market, these strategies can be a very useful addition. Well, thanks for joining me today and learning a little bit about trend following ETF. If you'd like to understand how much risk is currently in your portfolio and whether this would be a good idea for you to use, just click the link below and we'll schedule a call together and we can work together to make a portfolio that's aligned with your financial goals. Thanks so much and have a great day.